The Psychology of Investing, Why Your Mind is the Real Market to Master. Welcome back to Pie Uncut Finance, the show where numbers meet narratives and markets meet mindset. Today, we're going inside the most unpredictable market of all, your mind. Every investor dreams of buying low and selling high. However, few realize that the biggest obstacle isn't Wall Street, it's our own psychology. From greed and fear to overconfidence and herd behavior, emotions often decide our trades long before logic does. So, in this episode, we explore 13 powerful insights that reveal how the mind moves the markets and how mastering your psychology can change your investing life forever. 1. The market is rational, investors aren't. Let's start with a truth most people ignore. Financial markets reflect human emotion as much as economic data. When prices surge, greed whispers, "This time is different." When prices fall, fear shouts, "Get out now." Understanding that investing isn't purely mathematical, it's psychological, is your first step toward consistency. Markets rise and fall, but emotions amplify those moves. 2. Confirmation bias, the echo chamber of investing. Ever caught yourself Googling why Tesla will go up instead of why Tesla might fall? That's confirmation bias. It's when we only seek information that supports what we already believe. The danger is we miss critical facts that challenge our assumptions. Smart investors don't seek validation. They seek truth, even when it's uncomfortable. 3. Loss aversion. Why losses hurt more than wins feel good. Behavioral economists Daniel Kahneman and Amos Tversky discovered something fascinating. Losing $100 feels about twice as painful as gaining $100 feels good. That's loss aversion, the reason people hold losing stocks too long, hoping they'll come back. Ironically, the refusal to take small losses early often leads to bigger ones later. In markets, accepting loss is not failure, it's strategy. 4. Recency bias, the trap of the present. When markets rally for months, investors think they'll never fall again. When they crash, it feels like they'll never recover. This short-term memory is called recency bias, and it fuels both bubbles and panics. The antidote? Step back. Look at decades, not days. Market history is a pendulum, not a straight line. 5. Fear and greed, the twin emotions of the market. Every chart you see, every boom, every bust, can be traced to two primal forces, fear and greed. During bull markets, greed dominates. We chase hype, follow the crowd, and believe valuations don't matter. During crashes, fear takes over. We panic sell at the bottom, only to watch prices recover later. Understanding when you're being ruled by these emotions is like turning on the light in a dark trading room. 6. Herd mentality. Following the crowd off a cliff. Think back to the 2008 financial crisis or the meme stock mania of 2021. People didn't sell or buy because of fundamentals. They did it because everyone else was doing it. That's herd mentality, and it's one of the most destructive forces in finance. When everyone is rushing into one direction, stop and ask, if this goes wrong, who's left to buy or sell after me? 7. Discipline. The antidote to emotion. So how do you protect yourself from these biases? The answer is discipline. Have a plan, stick to it. Whether it's dollar cost averaging or rebalancing once a year, consistent systems beat emotional reactions. A disciplined investor treats volatility like weather. Sometimes stormy, sometimes sunny, but never permanent. 8. Keep an investment journal. Here's a trick professionals swear by. Write down your trades and your emotions. What were you feeling when you bought that stock? Why did you sell? Over time, you'll start to see patterns. Fear, overconfidence, impatience, and that awareness becomes your edge. Markets don't repeat, but human behavior does. 9. Know your risk tolerance and respect it. Everyone talks about risk like it's a number, but it's really a feeling. Some people lose sleep over a 5% dip, others don't blink at 50%. Knowing your emotional tolerance helps you design a portfolio that you can actually stick with during drawdowns. Because the best investment plan is the one you won't abandon when things get tough. 10. Learn from mistakes. Don't rationalize them. Every investor has a list of trades they'd rather forget, but great investors study their mistakes instead. Did you panic sell? Chase hype? Ignore valuation? Ask why. Document it. You can't change the past, but you can extract data from it. In markets, failure is tuition, if you learn the lesson. 11. Continuous learning. The long-term mindset. Markets evolve, technology changes, new asset classes emerge, but human psychology doesn't. Keep learning about behavioral finance, market history, and previous crashes. When you realize that volatility, bubbles, and rebounds are part of a repeating cycle, you stop reacting emotionally and start thinking strategically. Patience becomes power. 12. Build rules, not reactions. Rules save investors from themselves. Define your asset allocation and rebalancing strategy in advance. For example, if stocks fall 20%, will you buy more? If a single holding doubles, will you trim it? By deciding these rules beforehand, you turn impulsive reactions into calculated responses, the hallmark of professional investing. 13. You can't eliminate emotion, but you can manage it. Let's be honest, no one is immune to emotion. Even the best investors feel fear and greed. The goal isn't to become robotic, it's to become aware. When you notice emotion creeping in, pause, step back, ask, would I make the same choice if markets were calm? The longer you invest, the more you realize markets reward emotional intelligence as much as analytical skill. Closing thoughts. The mind is the real market. The great investors, from Warren Buffett to Ray Dalio, all say the same thing. Success isn't about predicting the market, it's about controlling yourself. Financial news will always fluctuate, but human nature? That's the constant variable. So the next time you're tempted to panic, chase, or follow the crowd, remember this. The best investors don't just manage portfolios, they manage psychology. Because in the end, the difference between profit and panic often comes down to one skill, emotional discipline. So keep your head cool, your rules clear, and your time horizon long. Because mastering your mind might just be the best investment you've ever made. Pie Uncut Takeaway. If you take one idea from today's episode, let it be this. Investing is not a test of intelligence. It's a test of temperament. When you learn to stay calm while others are fearful, objective while others are euphoric, and patient while others are impulsive, that's when compounding truly begins. So keep your head cool, your rules clear, and your time horizon long, because mastering your mind might just be the best investment you've ever made.